Guys, the reviews are in. SBA lenders are calling CorpSmart the best due diligence firm in the industry. CorpSmart is a one-stop shop for all of your due diligence needs, and in SBA lending, there's a lot. Searches, filings, vehicles, you name it. I remember I brought a deal in one time that involved an airplane. My credit guy looked at me and he said, "How are we going to go about perfecting a lien on an airplane?" I said, "I don't know, call CorpSmart." If you're not already outsourcing your due diligence, one, you're probably wasting a lot of precious hours that you could be using to go find more loans. And two, you could make a mistake, especially if you're lending across multiple states because every state is different. If you're looking to streamline and get more efficient this year, this is an easy layup. They can connect right into your LOS so you can order your searches with the click of a button and they'll appear right in their placeholder. To discuss your due diligence needs, visit the CorpSmart website at www.corp-smart.com and you can let them know I sent you. Hello and welcome back to the Art of SBA Lending. I'm your host, Ray Drew. Today we're going to be diving into a never before discussed topic on this show, and that is, how do you go about building a credit box for an SBA lending program? We all have that handy dandy grid in our credit policy that provides some guardrails in terms of risk appetite and structuring, but where does it come from? And what's the why behind it? Let's start by breaking down exactly what we mean when we say credit box. In SBA 7A lending specifically, we tend to have a grid that is broken out between the different types of projects we finance, change of ownership, startups, real estate, expansion, etc. And it details out the different debt service requirements, unsecured exposure limits, equity injection requirements, stuff like that. This gives the sales and credit team some direction in determining what a deal looks like at their shop. Now, of course, these credit boxes may change over time as the chips fall where they may in the portfolio and as the macroeconomic environment changes, but you got to start somewhere. When a bank starts up an SBA program, this typically unfolds one of two ways. The person they're bringing in to build the SBA program will present their recommended credit matrix and work to gain buy-in from the bank management team on the types of credits that they're going to expect to see as a result. And they're going to do that before accepting the position as SBA director. Or that won't happen. You'll take the job and you'll figure it all out later. And then 6 months in, the bank realizes SBA deals look a certain way and they just don't want to do it anymore. And that's something you've seen again and again in our industry as well. And that's why this credit box thing is so important. Now, most shops have like a director of SBA credit, and their input in buying is critical, especially if the SBA director is compensated on production and not profitability. Now, if I was a bank, I would compensate the director based on profitability or stock, but that's another episode for another day. But at the end of the day, I believe that the person in charge of the program should kind of set the tone, of the credit matrix and work to gain buy-in from all the stakeholders, and that includes the bank management team and the SBA credit management team. Okay, now let's dive into what a credit matrix looks like. Let's start with business acquisitions, for example. Are you okay with large goodwill deals? What is your minimum debt service coverage ratio? Do you want 1 full year or 2 full years of adequate debt service coverage? How much equity injection do you need? How much can come from a seller note? On and on. Now go to real estate purchases. Are you going to finance up to 100%? Will you underwrite projections? What are we discounting the real estate to? These are all the factors that go into creating a credit box. Now, at one end of the spectrum, you can optimize for protection. You can take a conservative approach on all the different types of factors, but just know your pricing is going to have to reflect that. If you're out here looking for 9% average premiums, you're going to need a box that's less conservative. The box essentially is a dial. Turn it all the way to the left, defaults remain low, revenue remains low. Turn it to the right, revenue blasts off, and defaults could spike. I like to be somewhere in the middle. Creating a credit box requires having a strong understanding of the market and a keen sense of credit. The success happens in the margins. You've got to find your edge. Now, of course, we'd all love to have a conservative credit box and just go out there and crush it and book profitable loans. But the market is the market. You need to decide where your risk appetite is and then price deals accordingly. Or you need to determine how much return on allocated capital you want and then formulate a credit box that can generate those results. I'll give you an example. There are banks that are a little more conservative on business acquisitions. They want 10% equity plus a seller note. They'll only advance 75% to 80%. They want 2 years of debt service coverage, but they'll price deals at prime plus 1 and prime plus 2 on 10-year paper. On the flip side, there's banks that will finance 90% business acquisitions, 5% cash, 5% seller note, and they'll price deals at prime plus 2.75%. So if you want to price deals at prime plus 2.75%, but stick to a more conservative underwrite, you've got to ask yourself, why would the marketplace do business with you? You can't chase A- paper with C+ pricing. Now, I will say if you hire really good BDOs, they can win deals with an inferior product if it's within, let's say, 50 basis points, but that's only because borrowers will pay a premium for steadfast execution. Now, once the credit box is in place, it's time to hunt. Your sales team will extort the crap out of this credit box. They will figure out the most competitive corner of the box and go out and create entire verticals around it. The box tells the BDOs where to hunt. If a BDO brings in a deal that fits the box, the sentiment is that the deal will most likely get approved. And if the deal is outside the box, well, it better have a good mitigant. And the credit team can rest assured that they are recommending approvals on deals that fall in line with the overall risk appetite of the institution. The credit box is the heart of the SBA shop. It can make or break you. And here to break it all down, we have our panel of SBA contributors: Jeannie Yoder, SBA Regional Executive at United Community Bank; Brian Carlson, SBA Managing Director at Mission Valley Bank; and Chris Kwiatkowski, President of Government Guaranteed Lending at Dogwood State Bank. Folks, welcome to the show. Chris, I'm going to go to you first on this. Why don't you tell me how it all went down 5 years ago when you launched Dogwood's SBA program in terms of the credit box?
Sure. We are a generalist SBA lender. That's who we want to be as community bank. And so it was really a negotiation between the chief credit officer, CEO, and myself about who we wanted to be, how we wanted to go to market, et cetera. So, it's a give and take. And you mentioned before in your monologue that you need to know what you're getting into before you sign on. It's as much what you can do, also what the bank is willing to give you to do it. So the credit box is one important element of that, but it is definitely a collaboration. And if you're not on the same page and you're going to be butting heads with the chief credit officer the whole time, it's going to be a very bleak existence. So collaboration, I guess, at the end of the day is the name of the game.
Brian, how did you approach credit box when you were in discussions to come over to Mission Valley Bank?
Well, I've been actually in SBA lending for a long time, so it gives you a lot of experience on what works and what doesn't. And so I've kind of come up with my own credit model and just laid it out in a business plan, saying, hey, these are the types of deals that make sense and you get repaid on, and then took it down level by level down to the more riskier deals, and that if we're going to dabble in any of these riskier deals, obviously you have to have very strong mitigants to offset that. But Chris is absolutely right. You have to get complete buy-in from the CEO and the chief credit officer if it's going to work.
How do you see it, Jeannie? What's the purpose of putting together a credit matrix, and how impactful is it to the success of an SBA shop?
Ray, I would just like to echo what Chris and Brian said. To be successful with an SBA division, you have to have the buy-in from the top. So, for example, at United Community Bank, Rich Bradshaw, our president of the bank, is a big advocate of SBA. And so if you don't have the support of the chief credit officers, the executive leadership team, it will be very hard to have a successful SBA division. I think it really does come from the top down, and open dialogue to understand what banks, what everyone has a credit appetite for. In specifics, there's a lot that goes into it, Ray.
So how do you go about building a credit box? I want to go to each of you with this one, because this episode's really on how to build the credit box step by step. There are directors that are watching. In fact, there's an SBA director who gave us this topic as an idea. So I'm going to go to each one of you. I'm going to start with Brian. Brian, where did you start when you were kind of putting pen to paper there?
Probably 30 years ago, I thought, I've got this figured out. I'm just going to do real estate loans and, we're good. It was funny. I was talking to a chief credit officer who was a lot older than me, a lot more experienced at some conference. And he says, no, Brian, it's really about management experience. You have to focus on management experience, kind of can this person really execute? And, we had had a debate back and forth about this. And at the end of the day, I learned years later that he's absolutely right. So certainly, if you're going to be lending, you have to have cash flow. The transaction has to make sense in terms of the person's personal net worth and liquidity in relation to the loan size. But kind of my experience has been that if you really have good management, and I'm not just saying someone with a degree from Harvard, someone who's actually proven themselves, then you get good results on the loan. And so, I mean, your question is pretty broad. So I mean, you could be talking a few hours about this, but
No, it's good.
that is one of the things that I think it's overlooked, and it's not so easy to evaluate too. It's fairly subjective.
That's right. That is the tricky part there, is evaluating that experience. Do you have anything to add to that, Chris, in terms of just how to build the credit box?
Yeah, it's interesting what Brian said. I mean, I've been doing this for over 30 years myself, and we all bring something to it. I started my career as an underwriter at the SBA. So, I've kind of grown up in the SBA culture of credit. But I think where the magic happens is on the edges of the box. We all say credit box, right? But it's, as Brian pointed out, well, you got real estate. That's great to have collateral, but management experience and then it's industry. There's so many things that go into it. So, there's really a magic to credit. That's why we say it's an art and not a science. And it's important to understand credit because as a salesperson, business development officer, you're bringing in deals. Hey, it meets the credit box, but there may be a glaring problem with the loan, and you still have to be realistic and common sense about, I understand it meets our box, but this still isn't a deal we're going to do, and that's difficult for some people to swallow. So again, the magic happens in the margins. We all do need a credit box to work from. You've got to start somewhere. It's your roadmap. I mean, the credit box and the comp plan are the roadmaps for the sales team. All right. If you're not looking at those two pieces of paper, I'm not sure what you're doing. If we did something wrong. But being able to work within that credit, the margins of the credit box, the credit guidelines, and tell the story about why a deal makes sense. So you have to have your foundation, but then you also have to have an understanding of basic credit. And that's where I go back to, it's an art, not a science.
Yeah. So in other words, that's a good point. The box doesn't mean it's an automatic approval just because it meets the box. And
I always tell people, we're going to do deals. You're going to be like, wow, I can't believe we got that done. There's other deals we're not going to do. You'd be like, why didn't we do that? It happens all the time.
yeah, and that's why that's why putting a box together is just so tricky, Jeannie. Like this is not it's so hard to put deals in a box in SBA because every deal is so different. How do you think about this?
Well, Chris has a great point. Everyone has a foundation and a credit box. And let's say, for example, we have a borrower that brings you a fantastic deal. But let's say, for example, your bank may have a concentration of that specific industry type. It's not because it doesn't fit your box, but perhaps your portfolio is full of that. So there's a lot of factors we have to look at when we assess these opportunities. And thank God we're all friends. We can help each other.
Right.
It's to Chris's point, it's not science, it's an art. We have to have open, candid conversations. We have to understand the mitigations, the risk, and what other sources do they bring to the table. There's a lot of outside factors that influence opportunities. Like, for example, are there secondary source of incomes?
Well, and let's dive deeper on that, Jeannie. And by the way, I would be remiss if I didn't, remind everyone I named the podcast The Art of SBA Lending for a reason. But I want to talk about post-close liquidity because this seems to be coming up a lot these days. Jeannie, do you think post-close liquidity is a big factor in determining credit risk? And have you seen that laid out in a credit matrix before?
I haven't actually seen certain guidelines laid out, but I do think it's important. You don't want to take a borrower and drain them from all their liquidity. We never want to set anyone up for failure. If they don't have sufficient post-closing liquidity, and let's say, for example, when a BDO didn't provide enough working capital, that could be a situation for disaster. So we need to make sure we assess their personal financial liquidity. If it's a business acquisition, is it a stock purchase, accounts receivables, what will be coming with it? There's so many factors we have to look at and we have to review to make sure that we are putting our borrowers in best possible solution for success.
Yeah, I do think post-close liquidity is critical. And people ask me, well, how much do I need? And I always say the more the better. And they hate that because it's not a real answer.
Right, each scenario is different. We would want more post-closing liquidity on a $5 million deal than we would a $200,000 deal.
Right, exactly. If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. So it's no surprise that they just created their, wait for it, 1800th custom business plan. And they wanted me to thank all of you for helping make that possible. In fact, Rapid Business Plans hosts an annual lender appreciation event to show how much they appreciate your support. Tyler Palooza, which is of course named after their #1 referral partner this year, will be hosted at Bethany and Ross's home in Neptune Beach, Florida on Saturday, October 12th. For more information about the event or to find out why so many top producing BDOs recommend Rapid Business Plans to their small business borrowers for their business plans and feasibility studies, click the link in the description below. Now back to the show. So Chris, how much impact does competition have in building a credit box? Like, do you have to consider what the market is doing, or can you just kind of put what you feel comfortable together and just kind of put it out there in the market and see what happens?
Yeah, in a perfect world, you'd love to work, outside the confines of what competition forces you to do or doesn't force you to do. Nobody likes, just because somebody else is doing it doesn't mean you should do it. And we have to tell our sales team that all the time. It doesn't mean it's the right thing to do. We've lost plenty of deals to competition that has come in with a lower rate or a fixed rate, but strips all the working capital out of the loan. And the borrower can't see beyond that rate because all they know is their home mortgage and getting the lowest rate possible, when they don't realize there's one bump in the road that could upset them. Oh, let's just say prime goes up by 525 basis points. That happened. We have a borrower that did a small franchise, children's consignment shop franchise. When we did the loan, their interest payments were about $30,000 a year. Now they're $90,000 a year. Now I'm not saying post-close liquidity would save that, but there are those bumps in the road that you can't see. As much as we try to build in enough operating capital at the start of a loan, every one of our borrowers gets proper operating capital. We don't leave it. We don't strip it out. We want them to have proper operating capital, and we would love them to have some post-close liquidity in a perfect world. So, it is pretty crucial. It is important. But again, you can look at the deal, as Jeannie was pointing out, the receivables coming with it. With the business acquisition, that's difficult sometimes to ensure that those receivables are coming with it, or to ensure that those receivables are actually collectible. So it's that balancing act again. And so if, in a perfect world, I would create my credit policy, my credit guidelines, if you will, and then if competition influences it, we're going to take a look at why the competition may or may not be doing that. And we still may walk from the deal.
Mm-hmm. Well, Brian, let me ask you this. Does regulatory become a factor at all? Like, if you build a credit matrix and you're approving loans outside of the matrix, does that cause a problem at all?
Well, certainly, if as a bank, if you're closing loans outside of policy, it's going to get noted by the regulators. Now, if you say, "Hey, we made a policy exception on this loan for this reason," you can address it, but you can't be constantly making policy exceptions. One other point I wanted to make through all this is that, one of the challenges when, people like Chris, Jeannie, and I go to, say, a new bank, and there are a lot of seasoned commercial lenders there at the bank, and they don't understand how to evaluate the risk on SBA. It's like if you're playing poker and suddenly says, "Oh, now we're going to make deuces wild." Well, that changes things. You have a different hand to deal with, and so that is really where the education process is. And what I found over my career is that it takes a long time to get people to start kind of perceiving, okay, where that guarantee helps you, and why it's okay to maybe have the deal more highly leveraged and things like that. And just to get back to the liquidity issue, I totally agree with Jeannie and Chris that you need to make sure there's enough working capital in a transaction. You don't want to give people back their down payment, but you want to make sure there's enough there so they can handle some bumps in the road when they get started.
Interesting. So, Chris, how is unsecured exposure being considered by banks at this stage in the game? I mean, these loans by and large don't have a lot of collateral, right?
Mm-hmm. No, they don't have a lot of collateral, but if you're a true SBA lender, this is something that you understand and you buy into, and that brings up another point. SBA lending can be different at any bank. You look at it differently. Some look at it just at a credit enhancement. Some people would say some banks put an SBA guarantee on conventional loans. We're a true SBA lender, so these are the types of deals we look at. What we're looking at with goodwill and business acquisitions, obviously a strong cash flow stream, and then you're really looking at the borrower who is buying this business. What's their capacity? What are their capabilities? Obviously, the perfect scenario would be a partner buyout where they're already in the business and there's no transition, because it's that transition area, that gray area where things can go wrong. You're peeling back the onion. You didn't realize this when you were going through your due diligence, et cetera. So that's the ultimate opportunity to strike. But you may have in that instance partner buyout or maybe even manager buyout, where the manager of the business has been running the business, but they don't have the wherewithal. They don't have the downstroke, or the post-closing liquidity. But is their management experience and that cohesiveness of the continuity of continuing on the same track they were on more important than post-close liquidity? Sometimes it is. Sometimes those are the best deals. When you're looking at goodwill, you've got to be, and I enjoy doing goodwill lending because it's more of a challenge. Okay, what are we looking at here? What are all the pieces on the table? If it's not meeting guidelines, what's my mitigant to that? And that's why I always like my sales team to lead with, all right, guys, here's the deal. Here's what doesn't meet guidelines. Here are the shortfalls, but here's how we can mitigate that. Let's put it right up front. Let's not leave it to the end. Oh, this is a great deal. Oh, by the way, they don't have any money to put in. Or by the way, there's no collateral. Don't do that. So there's a challenge in goodwill lending. I think there are a lot of good loans out there that are goodwill loans, but you just have to work a little bit harder to find them.
Yeah, and we all love cash flow, but when, Jeannie, is projection-based lending okay, do you think?
I think projection-based lending is good for some startups. Franchise lending is a great area to talk about projections. I think also expansions. Like, for example, let's say I'm a doctor and I've got one location, it's up and running. I've had it for a couple of years and I want a second location. We'll look at projections on that scenario. I think when it's a change of ownership, and this to Chris's point, and if I bring, let's say, for example, I'm an executive and I've had a lot of experience in the marketing field and I'm buying a marketing company, maybe we can look at projections for an underperforming company that's cash flowing for a year and a half. So I think there's a lot of different scenarios, and I think this is where common sense will apply as well. But I think projections are important in the right scenario.
So I'm going to go to you now, Brian. What's the one thing that you absolutely don't want to get wrong when you're designing your credit matrix?
Here again, it's a pretty broad question on designing the credit model. Not everything can be weighed the same. It's like, so I said the emphasis is management experience. Yeah, obviously you need cash flow. You want to lend to people with good credit histories, and again, that they have net worth and liquidity support that size of transaction. Obviously, because you have a 75% guarantee, you can be a little more flexible on collateral. The government is doing this to mitigate 75% of that exposure. So I think most people can do a cash flow. So obviously you have to make sure you've got cash flow. But I think the critical piece of this is, how do you really evaluate management experience?
What about character? What do you do for character?
We're fairly conservative on credit in the sense that, I guess maybe yes and no. So people that have tax liens, lawsuits, bankruptcies, obviously those are red flags you need to be aware of. If someone's credit report looks like a rap sheet, we're not going to give them a loan. But I've seen people that have fairly low credit scores, and it's like, well, they got a lot of credit, but they pay their bills, so that doesn't scare me so much. And if someone's got a few dings here and there, okay, well, you give them a little latitude, but beyond that, if it gets to be more than just that, then we're probably not going to want to do the deal.
I was just going to say, Brian, I think character is extremely important. I think when you have these loans, especially the bigger loans, you can speak to them over the phone, you can send various emails, but I think visiting a borrower face to face is extremely important.
I'm just curious, Jeannie, is that something that because we've had Live Oak on here and they've said that. Is that something that you picked up when you were there, or is that something you felt like throughout your whole career?
I have pretty much done that my entire career.
Wow. Yeah, there's something to be said for that. Have you ever met with somebody and just not felt right after the meeting?
Unfortunately, I've been in banking 35 years, and there's only been one bar I can say in 35 years where I just didn't get that feeling. So yes, and this one person sticks with me. Not and it wasn't that I did not think he or she was capable. I should say they were just a difficult person to work with, if that makes sense.
Interesting. Yeah, and that's good advice. I mean, with business acquisitions, buyers and sellers, buyers shadowing around a seller, seeing how they operate, not always possible, just because the way these transactions are structured, the sellers don't want to kind of reveal that they're selling the business too early in the process, but invaluable if you can do that. So what's the deal, Chris, with some of these banks wanting to basically underwrite conventional loans with SBA guarantees on them? Where does that come from?
That's a good question. Maybe they're trying to meet CRA. Maybe they want to be able to be seen as a complete lender, and we provide these types of loans, or it's just an extremely conservative credit culture. Again, sometimes you don't know what the premise is that a institution wants to do SBA lending. And as we've all said, that's why it's important up front to understand what you're getting into. When you get interviewed for a position, I like to flip it around. I'm interviewing them as well. I want to know what they're looking for, what they're willing to give me in order to operate a successful shop, because I've never been the person that wants to do SBA lending halfway. I need a complete shop. I need a complete focus on SBA if we're going to do it right. And so other institutions where they just want to dabble, or they just want to be able to slap a guarantee on a lot of small loans, that's their prerogative. And, we can have a debate about that and have a whole nother session, on that topic alone.
Love it. Well, I got a good one here for you, Brian. If the SBA does raise the limit here to 7.5 million for 7A, do you think every shop's going to then just start doing $7.5 million deals the next day? The same way they were doing $5 million deals, or are they going to be more cautious and create more conservative parameters around those larger deals?
I would say I would expect that the lenders that are maybe in the top 100 in production are probably not going to have too much reluctance to go up to $7.5 million. Now, $7.5 million on an unsecured type of transaction, yeah, that gives you more pause. But $7.5 million, on just a typical business loan with real estate or whatever, that wouldn't scare me.
Well, Jeannie, I'm going to go to you to wrap us up here. When it comes to a credit box, do you prefer more or less? Like, do you want a grid that is super detailed and specific, breaks down what you want to see per industry, per loan type, and, even goes into specific industry metrics? Or on the other hand, do you want something more broad and high level?
No, I think there's a credit policy and credit box needs to be in place because you need a foundation. Otherwise, it could be like the wild, wild west. A bunch of gunslingers out there shooting at everything, correct? And I think once you have some guidelines in place, there's always this mitigating factors. There's always that open dialogue, the conversations. Well, give me reasons. Why do you think this way? Does it make sense? A lot of times, common sense and good judgment comes into place. The area, the demographics. It could be a great project, but in their second location, let's say, is going in an underdeveloped area. Do you know, there's so many factors to it. So I do think it's important to have some guidelines in place and have conversations with the guidelines.
Yeah, if I could piggyback off that, I agree with you. You need a good starting spot because you can waste a lot of time, and we
Right.
don't have time to waste. Time is money, and we want to make sure that our team is going after the types of deals that we can get done so they can take care of their referral sources and their borrowers. And if you just you have too wide a span, so you're bringing in all these different types of deals, and every deal becomes its own story, and you're going to spend so much time underwriting all of these deals. It becomes difficult. So you need these guidelines, and I use guidelines and not policy. And in your guidelines, I believe the word should be used and not must, because you can paint yourself in a corner very easily. As Brian pointed out before, you get with your regulators, they're saying, well, your guidelines, your policy says you must. Yet on all these loans over here, you did not. What's going on there? So should versus must. Don't paint yourself in a corner. That's important.
Invaluable golden advice, panel. Thank you so much for being with us today. That was great. Know your deal. Big undertone of this whole entire conversation. That wraps us up for today. Until next time, ta-ta. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The BDO Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.